Berkshire Hathaway Incorporated. To the stockholders of Berkshire Hathaway Incorporated. Operating results from 1974 overall were unsatisfactory due to the poor performance of our insurance business. In last year's annual report, some decline in profitability was predicted, but the extent of this decline, which accelerated during the year, was a surprise. Operating earnings for 1974 were $8,383,576, or 8.56 per share dollars. For a return on beginning shareholders' equity of 10.3%, this is the lowest return on equity realized since 1970. Our textile division and our bank both performed very well, turning in improved results against the already good figures of 1973. However, insurance underwriting, which has been mentioned in the last several annual reports, is running at levels of unsustainable profitability, turned dramatically worse as the year progressed. The outlook for 1975 is not encouraging. We undoubtedly will have the sharply negative comparisons in our textile operation and probably a moderate decline in banking earnings. Insurance and underwriting is a large question mark at this time. It certainly won't be a satisfactory year in this area and could be an extremely poor one. Prospects are reasonably good for improvement in both insurance and investment income in our equity and earnings of blue chip stamps. During this period, we plan to continue to build financial strength and liquidity, preparing for the first time when the insurance rates become adequate, and we can once again aggressively pursue opportunities for growth in this area. Textile operations. During the first 9 months of 1974, textile demand was exceptionally strong, resulting in very firm prices. However, in the fourth quarter, significant weakness began to appear, which have continued into 1975. We currently are operating at about one-third of capacity. Obviously, at such levels, operating losses must result. As shipments have fallen, we continually have adjusted our level of operations downward so as to avoid building inventory. Our products are largely in the curtain goods area. During a period of consumer uncertainty, curtains may well be high on the list of deferrable purchases. Very low levels of housing starts also serve to dampen demand. In addition, retailers have been pressing to cut inventories generally, and we probably are feeling some effect from these efforts. These negative trends should reverse in due course, and we are attempting to minimize losses until that time comes. Insurance underwriting. In the last few years, we consistently have commented on the unusual profitability in insurance underwriting. This seemed certain eventually to attract unintelligent competition with consequent inadequate rates. It also has been apparent that many insurance organizations, major as well as minor, have been guilty of significant underserving of losses, which inevitably produces faulty information as to the true cost of the product being sold. In 1974, these factors, along with the high rate of inflation, combined to produce a rapid erosion in underwriting results. The cost of the product we deliver, our repair, medical payments, compensation benefits, etc., are increasing at a rate we estimate to be in the area of 1% per month. Of course, this increase doesn't proceed in an even flow, but inexorably inflation grinds very heavily at the repair services, to humans, and to property that we provide. However, rates virtually have been unchanged in the property and casualty field for the last few years. With costs moving forward rapidly and prices remaining unchanged, it was not hard to predict that would happen to profit margins. Best's, the authoritative voice of the insurance industry, estimates that in 1974, all auto insurance premiums in the United States increased only about 2%. Such a growth in the pool of dollars available to pay insured losses and expenses was woefully inadequate. Obviously, medical costs applicable to people injured during the year, jury awards for pain and suffering, and body shop charges for repairing damaged cars increased at a dramatically greater rate during the year. Since the premiums represent the sales dollar and the latter items represent the cost of goods sold, profit margins turn sharply negative. As this report is being written, such deterioration continues. Loss reserves for many giant companies still appear to be understated by significant amounts, which means that these competitors continue to underestimate their true cost. Not only must rates be increased sufficiently to match the month-by-month increase in cost levels, but the existing expense revenue gap must be overcome. At this time, it appears that insurance must experience even more devastating underwriting results before they take appropriate action. All major areas of insurance operations except for the home state companies experienced significantly poorer results for the year. The direct business of National Indemnity Company, our largest area of insurance activity, produced an underwriting loss of approximately 4% after several years of high profitability. Volume increased somewhat, but we are not encouraging such increases until rates are more adequate. At some point in the cycle, after major insurance companies have had their fill of red ink, history indicates that we will experience an inflow of business at compensatory rates. This operation, headed by Phil Yesh, a most able underwriter, is staffed by highly profit-oriented people, and we believe it will provide excellent earnings in most future years, as in the past. Intense competition in their insurance business has produced major losses for practically every company operating in the area. We have been no exception. Our underwriting loss was something over 12%, a horrendous figure, but probably a little different from the average of the industry. What is even more frightening is that, while about the usual number of insurance catastrophes occurred during 1974, there really was no super disaster which might have accounted for the poor figures of the industry. Rather, a condition of inadequate rates prevails, particularly in the casualty area where we have significant exposure. Our reinsurance department is run by George Young, an exceptionally competent and hardworking manager. He has canceled a great many contracts where prices are totally inadequate and is making no attempt to increase volume, except in areas where premiums are commensurate. With risk based upon present rate levels, it seems highly unlikely that the insurance industry generally, or we specifically, will have a profitable year in 1975. Our home state companies under the leadership of John Ringwald made good progress in 1974. We appear to be developing a sound agency group capable of producing business with acceptable loss ratios. Our expense ratios still are much too high, but will come down to the operation develops into the units of economic size. The Texas problem, which was commented upon in the last year's report, seems to be improving. We consider the home state operation one of the more promising areas for the future. Our efforts to expand home and automobile insurance company into Florida proved disastrous. The underwriting loss from operations in that market will come to over $2 million, at a very large portion of which was realized in 1974. We made the decision to drop out of the Florida market in the middle of 1974, but losses in substantial amounts have continued since that time. Because of the term nature of insurance contracts as well as adverse development on outstanding claims, we can't blame external insurance industry conditions for this mistake. In retrospect, it is apparent that our management simply did not have the underwriting information and the pricing knowledge necessary to be operating in the area. In Cook County, where home and autos volume traditionally has been concentrated, evidence also became quite clear during 1914 that rates were inadequate. Therefore, rates were increased during the middle of the year, but competition did not follow. Consequently, our volume has dropped significantly in this area as competitors take business from us at prices that we regard as totally unrealistic. While the tone of this section is pessimistic as to 1974 and 1975, we consider the insurance business to be inherently attractive. Our overall return on capital employed in this area, even including the poor results of 1974, remains high. We have made every effort to be realistic in the calculation of loss and expense reserves. Many of our competitors are in a substantially weakened financial position, and our strong capital picture leaves us prepared to grow significantly when conditions become right. Insurance, investment, results. Investment funds generated from the operation of our insurance companies continued to grow during 1974. Investment income grew correspondingly and produced overall profitability for the insurance group despite the poor underwriting results. As the insurance group balance sheet shows, we have increased liquidity substantially. This trend has continued since year-end. With poor underwriting and with generally weakened capital ratios throughout the insurance industry, such a higher level of liquidity is appropriate and comforting. It eliminates the possible temptation to write business at any price simply to maintain cash flow, which is a major problem faced by many companies. Several comments regarding market value of securities may be appropriate. Between the insurance group and the bank, we have approximately $140 million invested in bonds. About $20 million of this investment is in very short-term treasury securities or commercial paper, neither of which is subject to other than negligible market fluctuation. This leaves about $120 million in bonds of longer maturities, with a very large percentage of this sum in municipal bonds with an average maturity of perhaps 12 to 15 years because of our large liquid position and inherent operating characteristics of our financial businesses. It is quite unlikely that we will be required to sell any quantity of such bonds under disadvantageous conditions. Rather, it is our expectation that these bonds either will be held to maturity or sold at times believed to be advantageous. However, on any given day, the market value of our bond portfolio is determined by yields available on comparable securities. Such market values can swing dramatically. For example, during 1974, a leading index of high-grade municipal increased in yield from a level of 5.18% at the beginning of the year to 7.08% at the end of the year. In the bond market, each 1 to 100 of 1% change in yield is referred to as a basis point, and thus a change of 1% in interest levels is referred to as 100 basis points. As measured by the index, bonds yield increased 190 basis points during 1974. On a 15-year bond, an increase of 10 basis points translates to about a 1% downward change in market value. On $120 million of such bond, it is therefore clear that a change of 10 basis points in yields, which easily can happen in one day, changes the market value of our bond portfolio by something over $1 million. Thus, in 1974, our bond portfolio, which probably had a market value roughly approximating its carrying value at the start of the year, had a market value substantially below carrying value at the end of the year. The market value of our bond portfolio will continue to move in both directions in response to changes in the general level of yields, but we do not consider such movements and the unrealized gains and losses that they produce to be of great importance as long as adequate liquidity is maintained. Our stock portfolio declined again in 1974, along with most equity portfolios, to the point that at year-end it was worth approximately $17 million, less than its carrying value. Again, we are under no pressure to sell such securities except at times that we deem advantageous, and it is our belief that over a period of years, the overall portfolio will prove to be worth more than it costs. A net capital loss was realized in 1974 and very likely again will occur in 1975. However, we consider several of our major holdings to have great potential for significantly increased values in future years, and therefore feel quite comfortable with our stock portfolio. At this writing, market depreciation of the portfolio has been reduced by more than half from year-end figures, reflecting higher general stock market levels. Banking operations. There is little new to say about Illinois National Bank and Trust. With Eugene Lebesgue running the operation, the exceptional has become the commonplace. Year after year, he continues to run one of the most profitable banks in the United States while paying maximum interest rates to depositors, operating with unusual levels of liquidity and maintaining a superior level of loan quality. Two factors specifically should be noted in looking at the separate income statement of the bank. The effect of filing consolidated tax return is reflected in their figures, with the tax loss of insurance operations used to offset the tax liability created by banking operations. Also, property tax formerly paid by the bank now is assessed to the parent company and is reflected in corporate selling and administrative expense. Because of the accruals, this had a double effect at both the bank and corporate levels in 1974. Under present money market conditions, we expect bank earnings to be down somewhat in 1975, although we believe that they still are likely to compare favorably with those of practically any banking institution in the country. Blue chip stamps. During 1974, we increased our holdings of blue chip stamps to approximately 25.5% of the outstanding shares of that company. Overall, we are quite happy about the results of blue chip and its prospects for the future. Stamp sales continue at a greatly reduced level, but the blue chip management has done an excellent job of adjusting operating costs. The See's Candy Shops Incorporated subsidiary had an outstanding year and has excellent prospects for the future. Your chairman is on the board of directors of Blue Chip Stamps as well as Wesco Financial Corporation, a 64% owned subsidiary, and is chairman of the board of See's Candy Shop Incorporated. We expect Blue Chip Stamps to be a source of continued substantial earning power for Berkshire Hathaway Incorporated. The annual report of Blue Chip Stamps, which will contain financial statements for the year ended March 1, 1975, audited by Price Waterhouse & Company, will be available in early May. Any shareholder of Berkshire Hathaway Incorporated who desires an annual report of Blue Chip Stamps may obtain it at that time by writing Mr. Robert H. Bird, Secretary, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040. Merger with Diversified Retailing Company Incorporated. As you previously have been informed, the proposed merger with Diversified Retailing Company Incorporated was terminated by the respective boards of directors on January 28, 1975. We continue to view such a merger as eventually desirable and hope to reopen the subject at some time in the future. Warren E. Buffett, Chairman of the Board, March 31, 1975.